terms. So I hope you are ready to do a lot of writing. And I hope you're ready to stretch your brain, because we have some deep thinking to do, I think is the term I want. All right. Here we go. Types of consumer credit. This is the end of chapter 6, your personal finance section of the chapter. So we're going to break this down into sections. Your book does the same thing, and we're going to do a lot of defining of terms. I'm going to actually take you to a website because I want you to see how some of it works. So the first thing we're going to take a look at is installment credit. What installment credit is you make a purchase of something, and then you have a payment schedule of set amounts that you make in order to pay off whatever you purchased. So probably the most famous or best known type of installment credit is like a home mortgage. You purchase a home, you take out a loan, you have a life to the loan, and you pay the exact same amount every single month until the loan is paid off. So that's installment credit. So some terms that you want to be familiar with. These are financial terms or loan terms. And when I say terms, I mean terminology. You can have a single payment loan. This would be a loan in which you borrow a sum of money and you have one payment that you make. And that one payment is something that you pay off the entire loan plus its interest in full on the due date. Generally speaking, these are smaller amounts. It might be 30 or 60 days out from the purchase. So you're not going to borrow like $500,000 and pay it all back in one lump sum 30 years later. These are going to be, 30 days, same as cash, buy your furniture now. So you can buy the furniture from the store right now and not make a payment until 30 days out. So you have 30 days to get your money together, and then you have to pay the entire thing off in full. A term, this is not to be confused with the word that I used up above. A term, when we're talking about loans or credit, is the number of months within the length of a loan. So if I have a 30-year fixed loan, the number of terms within that loan is going to be I guess really the better way to define term is going to be the number of payments. Usually in a loan, you pay it every single month. It's not usually once a year. So we usually define terms within months. So if I had a 30-year loan, I would take 30 times 12, and I get 360. Is that right? So I'd have 360 payments that I would be making. And so the term is 360. The principal on a loan, that is the actual amount that is being borrowed. And you want to keep straight your principal versus your interest, because when you make payments on the loan, they break them apart for you. The interest is the amount that you are paying for the right to use the loan. So it is what the creditor charges to cover his cost of making the loan plus anything he expects to make as profit. Banks and lenders are not in the business of making loans just out of the goodness of their heart. They want to make money off of it. So they charge an interest rate that allows them to create additional loans, but it also allows them to make a profit on it. And that interest is broken apart separate from the principal. So when you get a loan, when you make a payment, you will actually see broken apart on there how much went to principal, that's the original amount of the loan, and how much goes to interest every payment. An amortization schedule. If you actually want to see, when you're getting ready to think about taking out a loan, whether it's for buying a car, whether it's buying a house, or some other purchase, you can do an amortization schedule. And what that is it's a table that gives you the breakdown of how your payments are going to be applied both to the principal and the interest. So it gives you an idea of how the money works. Now, stop and think this through. A lot of people have the thought in their mind that when they make a payment on their loan, half of it would go to principal and half of it would go to interest. That seems fair, right? Does anybody have an idea how your payment would actually apply? Anybody want to take a guess as to how they're going to apply your payment to your loan? Yeah, so they're going to apply to the interest first and then the principal. So the largest part of your payment hits interest and a small portion goes to the principal because you have a very large loan at this point in time. So you're slowly, very slowly at the beginning, whittling down the size of the loan. And then, so at the very beginning of your loan, a large portion of every payment is hitting interest and a very small amount goes to the principal. As the principal decreases, you'll watch your payment slowly flip. So at the very end of the loan, most of your payment is going to the principal and hardly any of it is going to interest. So I'm going to let you write that point down, and then the next thing I want to do is I want to open up this amortization schedule for you so you can actually see what it looks like. What is the common or the average price on a home here in Hollister? Anybody have an idea? About 500,000 would be appropriate. So can I go ahead and open this up? Are you guys done writing the point? Let me know when you're done so I can go ahead and open it up. Come on, make it bigger. Okay, so what I'm going to do is I'm going to change the principal to $500,000. This is a really low interest rate because that's about where we are right now. We're at a 3% interest. We're going to take a 30-year loan. So the term is actually going to be 360, but 30 years is what they're going to calculate it over. And I want you to watch. We're going to look at this amortization schedule. So here you see the term is right here. The number of payments you're going to make, 360. Your monthly payment would be $2,198. Now pay attention to your amortization schedule here. In your first year, you're going to pay, well, every single year of your loan, you're going to be paying $26,376.54. The very first year, only $9,000, almost 10, goes towards the principal. You're going to pay $16,500 in interest. So the balance on your loan, the principal still, is $490,000. So where is the majority of your money going that first year? It's going to the interest. So follow this down. Every year we pay a little bit more towards the principal. The turning point where you see that you're paying more towards principal than to the interest is going to be right around year 10. Right here you pay $13,322 on the principal, $13,054 in interest. So it takes 10 years into your loan where it actually flips, and you're going to put more than into principal than you do on the interest. Now that's on a 30-year loan. So by the time you get to the very bottom of the loan, if we take a look year 27, $23,000 on your loan is going towards your principal. Only $2,000, well, more like $3,000, is going towards your interest. So over the life of a $500,000 loan, look at how much you actually end up spending. You spend $791,000, almost $800,000 total. $291,000 of that is in interest. Okay? That is the fee that you are paying for the right of borrowing money. Now, that's for an investment in something like a home, and you understand that that's what you pay in order to have the right to own a home. So now, let's do something that's slightly different, and I want to do a different calculation. Give me a second to figure out how to do it. I'm going to go back to where I was. And let's say we carried $5,000 at 13%, and the term was, let's say it was 5 years. And this would be maybe, let's say, a credit card. You guys, somehow we managed to get into debt on our credit card. We weren't wise with our money. So they're charging us 13% interest on our debt, and it's going to take us 5 years to get all of that $5,000 paid off. Let's see what happens to it. If I finally manage to put myself onto a regular schedule, over 5 years, let me see if I can get my screen to scroll up here and work with me. No, stay shrunk down. There we go. Over 5 years, I am going to spend $1,825 in interest to get it paid off. That's a lot of interest. That's a lot of fees for $5,000. So I'm spending almost, by the time I get done with the principal and the interest, I've spent $7,000 almost, of which practically $2,000 of that is interest. So you want to be really careful with your debt and how you manage it. Okay, let's get rid of the amortization schedule. Any questions about what you saw? Okay. So when you take out a loan, the lender wants to make sure that he can get his money back somehow. So you are required to put up collateral of some sort. Collateral is simply a valuable good, something that is at least equal to the amount of money that you are borrowing. And that valuable good is what the lender can take a hold of if you should default on your loan. So generally, when you borrow to buy a home, the home is the collateral or the property. If you borrow for a car, then the car, or maybe the car is usually the collateral. It could also be, though, that if you're purchasing the car through like a home equity line of credit, then your home becomes the collateral for the car. So you default on your payments to the car, the lender can come in and take your home. So you want to be very careful what you put up as collaterals for your debt. A secured loan is another term. A secured loan is a loan that has collateral behind it. So if you default on a payment or on the loan, then the lender comes in and it takes the collateral in order to pay off the loan. And you would think, I mean, the logical train of thought is, well, wouldn't all loans be secured? I mean, who wants to loan money out to someone if there's no security behind it? There are such things as unsecured loans. An unsecured loan does not have any collateral. So how do you think a lender is going to deal with an unsecured loan? If you were the lender, what would you do if you were making an unsecured loan? Lenders are not in the business of losing money. They're in the business of making money. So how do they make sure they still make money? Yes, they're going to charge a significantly higher interest rate. They may, They may also charge a lot more upfront fees in order to get the loan. So anybody who goes for an unsecured loan, they're generally they're a high risk person. So that automatically means they're going to have a much higher risk interest rate right up front, probably more lending fees as well, because the individual who is making this loan wants to make sure that they're not losing money on it. These kinds of loans are a lot harder to get too, because, like I said, lenders are not in the business of losing money. They intend to make money. All right. When you take out a loan, and this would be true of even credit cards, because those are considered loans, you need to be aware of the fine print within your loan. And all that teeny tiny print can get to be very overwhelming. It seems like a lot of technical jargon. So let's make you familiar with some of the terms that you might find in that. There are all kinds of clauses that can be added to a loan. So you need to understand what you're getting into before you sign on the dotted line. An acceleration clause can be added to a loan by the lender. An acceleration clause states that if the borrower is late even by one payment on their debt or on their loan, then the lender can require that the entire debt be paid off in full immediately. So he accelerates the due date of the loan. That you would want to know that, especially if it's a big purchase like a home or a car. You would want to know if there's an acceleration clause, because that's the kind of payment you don't ever want to be late on then. As Christians, should we ever be late on our payments? No, we shouldn't. And it's heartbreaking when, as a Christian, I hear business people say that they don't want to deal with Christians because they are some of the worst in paying their bills. That just shouldn't be. Christians should be some of the best at paying their bills. And Christians are human, just like every other person out there, and they do get into times where they hit financial hardship, but they should be upfront and talking with their companies that they owe money to, asking to be put on payment plans. Just remaining silent and not sending in any payments is horrible. Most companies want to make money, right? They want to be paid. So if, as the person who is borrowing, you are struggling to make the payments, if you call them and talk with them, most places will be happy to adjust and work with you and help you make timely payments, maybe smaller, stretch them out a longer period of time. That might cost you more in interest and fees, but they will work with you because their goal is to get the money from you. They really don't want the collateral. What they want is your money. But if you don't talk to them, if you don't communicate with them, then they are forced to take other recourses. So being open and honest with those you've borrowed from is always the best recourse. An add-on clause, you might see these as well. An add-on clause, I would be very leery of an add-on clause. What the add-on clause allows you to do is, let's say I have a credit card or a line of credit at a store. Maybe it's a furniture store, and I go in and I purchase a bed, and then 6 months later I go in and I purchase a living room set. And so there are two separate purchases, 6 months apart, and I'm on payment plans for both of them. They consolidate the debt into one loan. So I'm on a 1-year payment plan for both of them. So I'm 6 months through the original purchase of the bed. I come in and I purchase the furniture. They add in the purchase of the furniture, and so now I have a loan that will extend another year out. And so for 6 months, I should be making doubled payments, one for my bed and one for my furniture. The way an add-on clause works is if, as the borrower, I default upon the loan, I lose everything. And if I had been good and I had fully paid off the bed within the time it was due, so I'd been making payments for 14 months. So I passed by the bed, I'd finished paying it off a year, and I'm 2 months into finishing off, 2 more months into finishing paying off the furniture. I only have, how many months would that be left? 4 months left to finish paying on the furniture, and it would be mine, and I default on my loan. The lender can come in and they can seize both the bed and the loan. It doesn't matter that I've already paid off the bed. What the add-on clause does is it allows them to seize everything that is on the loan. And since it consolidated both purchases, it can take it all. So that's what an add-on clause does. A balloon payment or balloon clause. This is helpful to an individual who is very disciplined and very wise with money. If you do not have the self-discipline to do this, to set yourself on payments and set the money aside and invest it, then never do a balloon payment. But what the balloon clause does is it allows the borrower to make small payments, generally interest only, until the very last payment of the loan. And at the very last payment, the principal comes due in full. So if I had a $500,000 loan, I could every single month only pay the interest. So figure over 30 years, it would be, what I would have paid off over that 30-year time would be the $271, like what we saw on our 30-year loan earlier. But on the very last payment of that loan, I need to come up with $500,000 to hand to them in one payment. So what I should be doing if I intend to do a balloon payment is every single month I should be taking the full amount of the mortgage, that $2,000, $2,000 whatever it was, and I should be putting a payment for the principal aside in a fund, probably some kind of an investment fund so that I can make interest on it, and send then the interest into the bank. And I do that every single month as if I am actually sending the full amount into the bank. So at the end of the 30 years, when that $500,000 comes due, I have the entire amount in hand. Why would someone choose to do a balloon payment? Why not just make monthly payments to the mortgage holder?